The massive tax overhaul passed by the Senate early Saturday morning will, if enacted into law, impact millions of Americans in different ways. By and large, the most costly provision continues to be reducing the corporate tax rate to 20%. The Joint Committee on Taxation, Junction, gives that a $1.4 trillion price tag. Republican claims the measure would pay for itself were also debunked this week by the Junction. Their analysis estimated the bill would grow the economy by 0.8% over a decade, still adding $1 trillion to the deficit. When it comes to individual income taxes, the Senate measure also makes broad cuts across income levels. However, most of the individual income tax provisions will sunset after 2025 unless Congress acts. The bill also includes a change to inflation adjustments that would raise taxes slightly compared to what they would have been under current law. By 2027, every income group under $75,000 is expected to see tax increases, according to the Joint Committee on Taxation. The corporate rate cut, from 35% to 20%, will be permanent. The Senate bill is not the final word. The Senate and House versions of tax reform have big differences, including the treatment of the health insurance mandate penalties, as well as the number of tax brackets. The two will need to be reconciled before they get to President Trump's desk. Here's how the Senate plan could affect you. The Senate bill maintains 7 brackets, the same number as exist under current law, but it also lowers most of the rates and raises many of the income thresholds. For example, a married couple making $200,000 in 2017 would have paid $42,884.50 in taxes. Under the Senate bill, they would move from the 28% to the 24% tax bracket, and their tax bill would drop to $37,079 before deductions are considered. The Senate bill would nearly double the standard deduction. For individuals, it would go from $6,350 to $12,000. For married joint filers, it raises that deduction from $12,700 to $24,000. This may result in fewer taxpayers itemizing their deductions, and the bill's supporters hope that standard deduction increase will help offset the elimination of other deductions. Generally speaking, if you are a taxpayer that takes the standard deduction currently, good chances are you get a tax cut, said Scott Greenberg, a senior analyst at the Tax Foundation. Taxpayers with large amounts of itemized deductions, some of them could see a modest tax increase. Lawmakers are trying to create a tax code where fewer taxpayers use deductions that are related to specific economic activities and more taxpayers use the standard deduction, Greenberg said. Who takes a hit? In the first 8 years, Greenberg says the potential losers are generally people who make great use of tax preferences rather than taking the standard deduction. A few stand out. People living in high-tax cities and states like New York and California will take a hit, though Susan Collins, Maine, lessened that blow in the final hours of negotiations by retaining some deductions for property taxes. The original bill completely eliminated the deduction for state and local taxes, SALT, but Collins insisted on retaining a deduction on property